2026 is shaping up to be a pretty strange year. The Middle East is still on a knife edge after several months. AI is apparently taking over the world, and we'll have robot overlords, soon enough. And recession indicators are flagging or flashing red. And the stock market still keeps like pushing to record highs, which blows my mind. So it raises an important question of where are you actually supposed to put your money right now in today's world? So we're going to walk through what's happening across stocks, real estate, alternative investments. We're going to walk through where Denny and I are putting our own money, our personal money right now, including one thing that I'm getting rid of. And Denny, we'll see if there's anything you're getting rid of currently. And most importantly, how you can position yourself in 2026 to come out ahead, whether or not the year, turns into a huge opportunity for gains or whether it turns into a big bust that catches a lot of people off guard. So Denny and I have been investing in real estate and stocks for over 6 decades now between us. And we organized the Co-Investing Club. It's an investment club that meets once or twice a month. We vet new hands-off real estate investments together. We go in on them together with small amounts per person. And we've done a lot of deals between the two of us. So on that note,
A
welcome to
lot.
the Bucks Outside the Box show, where we try to keep things a little creative, a little off the beaten path. And we try to challenge that conventional money wisdom and think outside the box. So, Zenny, any opening thoughts before we dive right in?
I just think that I remember my parents saying, "Oh, the world's just crazy." And my father talking about, where to put money and where not to put money and the whole nine yards. And I look at this, what we're going through, and it's kind of what they went through, different ways. But
Yeah, I mean, in some ways, the world is always going to hell in a handbasket, right? In its own way. And, the real challenge for us as investors is not to succumb to that trap of thinking, but this time it's different, right?
right,
Because, while history doesn't exactly repeat, right? It does rhyme. It does echo. So, all the things that we're seeing today, we have seen variations on these things throughout history. And it's up to us not to panic and think, no, this time is different. This time is
right.
unique. This is the first time this has ever happened in human history. Yeah, maybe the exact details is the first time it's happened in human history, but history does rhyme. So, you got to look back through the past and see how this has played out before and get some clues about how this is going to play out now. So, with that being said, let's start with stocks because that is the first investment that comes to most people's mind when they start talking about, where do I put my money and, like, asset allocations and, how much should I put in stocks versus bonds versus real estate versus alternative investments. I personally keep my stock investments really simple, really clean. Well, maybe not as clean as I wish that they are, but that is. But I'll talk about that in just a second. I invest in index funds, and I try to keep those very diverse as well. So I have large cap index funds. Things mirror the S&P 500 in the U.S., for example. I have small cap index funds. Things that mirror, say, the Russell 2000 index again here in the U.S. I also invest in international stocks. That is both
Oh, wow.
developed international stocks, places like Europe, and also emerging markets stocks as well. So, I'm not trying to pick stocks. I'm not trying to pick individual stocks, or even pick, actively managed funds that are promising to outperform the market. They no actively managed fund can outperform the market consistently over a long period of time. So, and that's because they charge such high management fees.
Mm.
So passively managed index funds is how I personally invest. For some of these, I do use a robo-advisor. I use Charles Schwab's robo-advisor because it's free and it's pretty good, and it has some more advanced features as well that you normally have to pay for with a robo-advisor, such as automatic rebalancing and tax cost or tax loss harvesting. Um, so yeah, I keep my stock investments pretty simple. And two final thoughts there. One is that I do practice dollar cost averaging with these investments, and that's part of my core strategy. So every week, actually, my robo advisor from Schwab will pull money out of my checking account into the robo advisor account, and then it will automatically invest that for me. So that's happening on a weekly basis. Some people do it on a bi-weekly basis when they get paid. Some people do it on a monthly basis. There's nothing wrong with any of those cadences. Um, so dollar cost averaging, that's a recurring theme. We're going to come back to that throughout this episode. Um, but I wanted to set the stage early with that with my stock investments. What am I selling in 2026? I'm selling individual stocks. I still have a handful of them left over from my younger years when I thought I would be clever and pick individual stocks.
When you
Um,
become more of a gambler?
Yeah, so I'm still unloading some of those individual stocks, and I'm also unloading. I'm trying to simplify my portfolio to include fewer funds because I think I have too many funds, even though they're all passively managed
Why is
funds.
that?
Just portfolio simplicity. Um, so it's not that there's anything wrong with any of those funds that I have invested in per se, but I've got a lot of overlap with those funds, a lot of funds that are, holding a lot of the same stocks and, are just too similar to really be useful in my portfolio. They're just adding clutter so that when I log into my account, there's 40 funds listed there instead of like six, you know? So it just adds clutter. It makes it more confusing to look at your account and know exactly where your money is, and what types of stocks. And I'm decluttering basically with my stocks in 2026. I'm getting rid of individual stocks. I'm trimming down the number of passively managed funds that I have in my portfolio and just trying to clean it up. Um, so, Denny, any thoughts that you have about how you approach stock investments?
I think it's interesting. My husband and I have a portfolio similar to what you were just talking about, but I think as we're a little older than you, and I think that when you start to get towards that age, um, well, we definitely look for more stability, definitely. And when we were younger, it was more risk, whatever you call it. Like there was,
Tolerant, more
we
risk
would
tolerant. Yeah.
yeah, but I think as we get older, that's kinda going off to the side, and we're definitely looking for more stable and boring no. You know how it is because we are, and, yeah, I have we have our 401(k)s and then the club passive investments, but, yeah, and we have some real estate, but I think that age has a lot to do with how to handle your portfolios.
No question. And where you are in your life and your age should really have much more of an impact on what you're investing in than whatever the market happens to be doing in that moment, right? We don't. One of your and my key themes, both in the co-investing club and in our own personal investments, is not trying to time the market because it's so tempting, both with stocks and with real estate. So don't try to time the market. It is a losing game. People who have much better access to data and information than we do still mess that up. So if they're going to mess it up, like these big institutional investors, if they mess that up, we're definitely going to mess that up.
Yes.
Uh, so don't try to time the market. So you talked about moving some of your money into safer assets. So some of that I assume might be like low volatility stock funds. I assume some of it's also in bonds. So you don't have to tell me what your exact allocation is with bonds, but you certainly can if you want to. Uh, but any thoughts on bonds before we move
I
on?
I actually to me it depends on the bond. My husband handles most of that. But we definitely are not that risk adverse of that we're going to kind of take a hit for lack of a better word, where we're just getting very very low return because we want to be safe. Um, if that makes any sense.
It does, and yeah. So I personally almost never invest in bonds. I'm not investing in 2026. And that's partially because of my age. I'm in my mid 40s, and I realize that conventional money advice is, to start investing in some bonds in your 40s. But of course, look to the name of the show, right? Like bucks outside the box. We are unconventional. Um, so yeah, as far as bonds go, I see a much higher risk from inflation right now in 2026. So, bonds are super susceptible to inflation risk. I mean, if you look at the interest rate you're earning from a bond, you have to subtract out the inflation rate to get to your real return for that bond.
And
And
I think a lot of people don't realize that. They see it as like, "Oh, it's safe," and even savings accounts anymore. I grew up and our parents were saying, "Gotta get your money in the savings account." That was where you put your money, and I was like,
for
"For
some
what?"
things, I mean, for like your emergency fund, maybe, or
Oh,
even a
well,
part of
yeah,
your emergency
right, but
fund.
not
Yeah,
for any,
not
like,
for any like, but not.
investment.
Yeah, yeah, no, it's not an investment. Yeah, so and you raise a really good point there about how people just unthinkingly assume that bonds are safe. Bonds, I mean, first of all, there is default risk with bonds, right? But default risk aside, even if there were zero default risk, people talk about treasury bonds having zero default risk, which is, we can take that as a given. Um, you have other types of risk, right? So we just talked about inflation risk, which we saw in 2022. Inflation hit 9.1%. Treasury bonds were paying like 2%. So you're basically losing you're having a negative return, a real return of negative 7.1% on your money at that point. So that is a real risk with bonds. Interest rate risk is also a big risk with bonds. If interest rates go up, then the value of your existing bonds goes down, right? And you can't if you're going to sell it on the secondary market, then you're going to lose money. So, this notion that, oh, bonds are super safe. I mean, they're less volatile than stocks, but they come with other risks. So it's not just about volatility. You've got these other risks in play too. Whereas stocks are much less vulnerable to inflation risk. Companies can raise their prices, right? I mean, they can adapt. Bonds can't. Like you're earning a fixed interest rate with bonds, at least in most cases. So anyway, um, and here's the other thing. I'll make one final comment about bonds in 2026, and the reason why I'm not investing in them is I look at our federal government debt levels, and the deficit spending, and it is crippling. At that last check, and this statistic is already years out of date because it's coming from the official government numbers, which lag behind by a lot. At last check, the U.S. federal debt was like 125.9% of GDP, which puts it in the same standings as like third world countries in Africa. I mean, it really it is not a healthy balance sheet for the government. So, what do governments do when they realize that they're carrying too much debt? They devalue their currency. So they basically inflate away the value of those older debts. So that is bad news for bond investors, right? For all the reasons we just talked about. So that's why I'm not investing in bonds, or at least one of the many reasons why I'm not investing in bonds in 2026. Okay, let's move on to real estate, which is obviously where your and my personal expertise is and where we've spent our entire careers. Um, so, as we touched on in the co-investing club, we meet every month, sometimes twice a month, and we invest in private placements. And this is how I personally invest my own money. I invest as just one more member of the co-investing club. And that's really important to me to keep that alignment of interests, right?
Right.
With the co-investing club. I want my personal money right alongside all of our members' money in the co-investing club. Because this whole club, it hinges on trust and transparency, right? Like, I mean, that if there's no trust, then we don't have a business. We don't have an investment club anymore. Um, so that alignment has always been really important to me. Um, so this is my personal strategy for investing. This is not just my career and business. This is where I'm putting my personal investment money every single month. So when we talk about passive real estate investments, we're talking about a few different types of investments. We're talking about real estate syndications, of course, but not just syndications. We're also talking about private partnerships, joint venture partnerships
Right.
with operators. We are talking about private notes, so fixed interest debt notes. The difference being that they're not paying 3 or 4%; they're paying 15, 16%. So there's a lot more cushion there for that inflation risk, um, and we see low default risk with those as well. Often we have incredible security for those, incredible collateral. So for
Right.
example, I'll give one really quick one. Um, we lent a private note at 15% interest to a guy who runs a land flipping company, and he does a lot of business every year, but he couldn't put those parcels up as collateral because he flips them quickly. So what did he do for the collateral for our note? He put up his primary residence, which was owned free and clear. So we got a first lien position against his primary residence, and our LTV on that was what, 50%, 55%. I mean, it was
Hmm.
crazy low. The loan to value ratio. I don't mean to use lingo for people who are not in the space. Um, so that's incredible collateral. Like if he defaulted on our 15% note, we could foreclose on his personal home and recover all of our money because the loan to value ratio is so low. So all right, so I got distracted there with a case study, but so JV partnerships, syndications, private notes, and also funds. We don't invest in a lot of funds, but we do occasionally invest in real estate funds. And I personally approach these this similar way that I approach my stock investments. Dollar cost averaging, right? We promised that would be a recurring theme, and here it is. So every month, again, sometimes twice a month, I'm investing money in new real estate investments, and I'm investing relatively small amounts at a time. So typically around 5,000 at a time, depending on the membership level in our club. We have some members who invest $2,500 at a time in these real estate investments. So it's not $20, right? But it's a lot less than the typical 50,000 or
Right.
100,000 that you would need if you were investing by yourself in these types of investments. So, relatively small amounts every month as a form of dollar cost averaging. So, markets, stock markets, real estate markets, they go up, they go down. We're not trying to time the market. We're just trying to invest slowly and steadily every single month.
And definitely diversification,
Mm-hmm.
because we don't just, I mean, we have oil that we've,
Well, we're going to
invested
get to
in,
alternative
gold and
investments in a second.
silver.
You're jumping ahead. You're jumping ahead.
Of course I did.
Uh, yeah, so diversification is a super critical part of this, and I'm really glad you brought that up. So when we look at real estate investments, we want to diversify not just across the type of investment, like we just talked about, syndication versus private note versus private partnership. We also want to diversify across geography, right? So different cities, different states around the country. We also want to diversify across operator. So, every month featuring a different operator and investing with a different operator, and we'll bring operators back year after year if we've had really good invest or good experiences with them. If
What
they've
would you
been
say the purpose is that we do that, that we diversify even with operators? E-
oh, because as you and we have seen this firsthand, Denny. As you're queuing up for me here, um, that some operators, you can vet them as well as you want, and you should, and we do. Uh, but there is still some operator risk, even if everything looks perfect on paper, even if they have a great track record, even if they have a sterling reputation in the industry. Uh, Stuff can happen. We have seen several operators who were like golden children, of the industry, who fell from grace and fell hard. And everything on paper looked great about them. When you met with them and talked with them, they said all the right things. They sounded sincere.
Got a
Um,
good reputation, the whole 9 yards.
yeah, deep track record. But what's the line from Warren Buffett? When the tide goes out, you can see who's been swimming naked. And of course, the tide did go out in the commercial real estate industry in 2022, and it has been there's been a lot of distress in commercial real estate ever since then, which is great for new investments, great buying opportunities, great for older investments, many of which are in distress right now, because interest rates went so high and because, rents have floundered across the country in many markets, at least. Values for multifamily properties, by way of example, crashed 25 to 30% in 2022 and 2023. So, to your point, Denny, about diversifying among operators, you don't want to just park all your money with one operator because operators can go bad. It doesn't happen often, but even operators who look and sound perfect, they
Mhm.
can they can go bad, and they do occasionally fall from grace, and they can take a lot of money with them when they fall. So
Which makes the investments that we do as a club a little bit, well, definitely a lot less risky because you're not putting $100,000 in one.
exactly. And because you get to start small with operators and build trust with them.
Right.
So, those operators we bring back year after year, you start maybe the first time you invest with an operator, maybe you invest 5 grand. Maybe the next time you invest 15 grand. Maybe the next time, a couple years later, you invest, you know, 30, 40, 50 grand. As you have developed trust with that operator, as you see their communication style and see how they handle curveballs, because there's always curveballs in real estate, right? Like, so that's why that diversification is so important. And one final note here about tying in diversification, but also real estate investments and why I continue investing month after month, uh, is that some real estate investments come with great tax benefits. Not all, right? Um, so, for example, that note that we just talked about, paying 15%, that's great for passive income, but there's no tax benefits for that, right? It's great for steady passive income. I love it. Every quarter when that hits my account, I'm like, oh, look at all that money that just hit my account that I didn't lift a finger for. That's great. But there's no tax benefits for that. Whereas some types of real estate investments, and specifically syndications, but sometimes private partnerships as well, can come with enormous tax benefits where you get a huge write off in the first year, which you can use to offset other types of investment income, or you can carry it forward to when that property sells and offset the profits from that. Um, but that is another reason we love real estate. That's also another reason for diversification, right? Uh, Denny, anything you want to add before we move on from real estate?
No, I don't think so. I will add this. I have had my own investments and I've managed other people's, and the aggravation of that was very stressful to me. So me personally, I would rather invest passively. So I only have one property left that's active, besides the one I live in. And yeah, I think there's that to take into consideration as well.
No question, and that's a great thought there to as we start wrapping up the real estate portion of this episode. You can obviously invest actively in real estate, buying properties yourself, renovating them, renting them out, or flipping them, or whatever. That's a business model. That's not. I mean, there's an investment element to it, of course, but that's really a business model, and there's nothing wrong with it. It's a great business model for people who are excited and passionate about
Mm.
starting that business. When I was in my 20s, I bought up a whole bunch of rental properties thinking that I was investing and not fully appreciating that I was creating a side hustle for myself. And then, realizing just how much work it was being a landlord, dealing with the tenants, dealing with property managers, dealing with city inspectors, dealing with contractors. Um, it's endless work. It's not passive. It is a
Mm.
business. And if you are excited about starting that as a business, whether it's a side hustle or a full-time business, that's great. I would never discourage you from that. If you are just looking for places to put your money and to get the advantages of real estate, the cash flow and the equity growth over time, the appreciation, the tax benefits, you don't need to start a business, right? You don't need to become a landlord. You can invest passively, and that's part of what we're doing every month in the co-investing club. So, yeah, I mean, we do a mix of stuff: multifamily properties, industrial properties, mobile home parks, like we talked about, notes, a land flipping funds. I mean, we do all kinds of stuff, and that's part of the point, right? That diversification. Okay, before we wrap up, let's talk about alternative investments, like you touched on a few minutes ago, Denny. So, precious metals in 2026, cryptocurrencies, oil and gas. Do you want to start off with any thoughts about any one of those, Denny, or where do you want to take this? I mean, I have my own thoughts, which we'll get to, but
Well, I mean, we all know that I grew up with a father who was involved in precious metals and recycling and everything else. So I have a special attachment to that. And just seeing the way, gold and silver prices are going like right now, I think that, I'm glad that I do have money in that. But as a diversification, not all of my money in that.
yeah, no, I mean, I've heard financial advisor after financial advisor say, you know, at a certain point in building wealth, it can make sense to add a little precious metals, to your portfolio. but not more than 5 to 10% is what I have heard them say just repeatedly. And that makes sense to me. It's really more of a defensive hedge, against geopolitical risk, against inflation risk. So yeah, I mean, I have a very small amount of money in precious metals, but even then, I actually did it through an investment that we did in the co-investing club,
Mm,
which was sort of a one-off, like unique one, where we bought some gold and silver, and then we used a platform that actually leases that gold and silver out to businesses who use it in their day-to-day
right,
operations, like jewelers, for example. Um, and so we earn a cash flow return on that. That we earn interest on that, and that interest is actually paid in ounces of gold and silver, which is kind of interesting. Um, but that's normally at a 3 to 4% interest rate, again paid in ounces. So kind of different, but it does add that missing cash flow component because otherwise, gold and silver it's pure speculation, right? Uh, there's no underlying revenue generated by it, which is my argument against cryptocurrencies, against precious metals, which is why I love stocks. And it's why I love real estate. Is that they create measurable revenue, which you can then use to calculate what is the market value of this property or of this business, um, as a multiple of how much cash flow it generates, right? I mean,
right,
these are concrete things you can measure. Whereas, what's the value of an ounce of gold? Whatever the next idiot is willing to pay for it, right? Or I'm not picking on gold, but that's speculation, right? There's no intrinsic value. It's just whatever somebody else is willing to pay for it, and it goes for cryptocurrencies as well. So I have a little money in cryptocurrencies. Um, it's play money. It's if all of it evaporated tomorrow, I might be a little bummed out, but it's not going to kill my portfolio. It's a very small percentage of my portfolio. Yeah, again, play money. Um, any final thoughts on either precious metals or crypto before we move on to oil and gas?
no, I didn't. I just to check things out way back when crypto first started becoming even a word. I did invest in some, and stupidly, I think I definitely it increased a whole lot, and I got out way too soon because of fear. So that's a lesson too. Don't act on fear.
That's true. But that's the problem with crypto is that like we are talking about, like it's so hard to know what the real value is, right? Are you selling it undervalued or selling it overvalued? Like who
It's
knows, right? Like there's no way of knowing. So, the irony is that in 2026, cryptocurrencies have actually been super stable with price wise. I mean, they crashed in late 2025, and I guess in the very beginning of 2026. And then they've been hovering actually in like the high 60s to, or Bitcoin anyway, has been hovering in the high 60s to low 70s really for like the last 3 months, more than 3 months. So yeah, the irony is that actually been way more stable than anything else on the table. Um, anyway. So yeah, I have a little bit of money in crypto. I do as a parting thought about crypto, I would urge people to have an exit strategy for it. Say, all right, I'm going to speculate on it. I'm going to buy in, and if it gets to this price on the high end, I'm going to sell it. If it goes below this price on the low end, I'm going to sell it to limit losses or to capitalize on gains. Or you can just hodl, as they say, hold on for dear life and not sell at all on the bottom end and just wait until it hits the next high, which is fine too. Again, with smaller amounts of money. Okay. Last but not least, oil and gas. Any thoughts on that in 2026?
you know, I am so confused by just what's going on in the world and over in the Middle East and how oil factors in on all that. I just see it as a commodity.
Yeah, no, and that is not a bad way of looking at it. I mean, it really is a commodity, and there's nothing wrong with having commodities in your portfolio. So, yeah, I mean that's the experience of oil in 2026 to date with the Iran war really showcases how volatile it can be and how one geopolitical event can send prices just to the moon. Uh, and at the time we're recording this, the war is still ongoing, and oil prices remain around $100 a barrel. When that when and if that war ends, everyone has been kind of assuming there will be a speedy resolution to this, but it hasn't happened yet. Um, Everyone keeps thinking it's about to end, and then oil prices will
Mhm.
drop, and then it doesn't end, and it goes back up. Um, so we have a little bit of in our club. We did make one oil investment, just again for diversification. It's outside of our normal wheelhouse, but we invested in a portfolio of wells in Texas, new wells that are being drilled as we speak, actually. Um, and that is a cash flow investment. We made that for the income. Oil wells, for anyone who isn't familiar with how the returns work, they pump the best in their first year or two, and then over
Mhm.
time, gradual decrease in performance. So you get and you earn your money back on the cash flow from those. So it's a cash flow investment that we made. Add a source of income to our portfolios, diversify the portfolio. That is a core value of ours. So do I have a ton of money in it? No, but a little bit of money as a cash flow investment, yes. But I'm not speculating on it by buying a fund, an oil fund, because
Mhm.
that is just kind of speculation on where is the price going to go. Like you said, Denny, you and I have no control and only limited understanding of the forces that are driving oil prices around the world.
Right.
So that makes it speculative to invest in oil. So again, just like we did with the precious metals, we wanted to invest from a cash flow, like a cash flow side of the equation, and that's why we invested directly, a working interest in those wells. Um, because that's a revenue based investment that you have some element of control over. We
Right.
obviously we can't control the price of oil, but we partnered with a well established oil group that they know what they're doing. They will be able to tap into. They know where to drill. They can tap into. They're in an established oil field, so those are somewhat predictable investments. Uh, Anything you want to add to that? Uh, or any other element of, where you're putting your money versus moving money in 2026.
No, I just think that it's just interesting, and you have to look at what's going on in the world, your own personal, financial stuff, your age. So there's a lot of things you have to take into factor, when you're doing these things.
Absolutely. Well, guys, we hope you got a fresh perspective out of this episode. If so, pass it on to anyone who you think will be interested, or wondering where to put their money in 2026. And lastly, consider joining the co-investing club. We meet once or twice a month. We look at new investments together. We vet them as a community, as a club. We go in on them with small amounts of money per person. And if you are not familiar with the types of investments that we were referencing earlier, syndications and private equity funds and private partnerships and the like, we have a free course breaking down all of those investments, pros, cons, risks, rewards, sparkrental.com/free. Check that out. And in the meantime, stay weird, unconventional investor.